Welcome to, for us, is our second webinar of the day. For many of you here, it may just be the first, but if it's your first or your second, no matter, you are very warmly welcome to this session. As always, before we start, may I draw your attention to the disclaimer that I know you can see on your screen. As you know, trading, not just Forex, but any other market, comes with a degree of risk. Please, you should make yourself aware of that risk, and please don't ever think of using money that you cannot afford to lose. And as I said this morning, and I know I haven't said this for some time, not only can you lose, in some markets, lose all of your money, but in some markets you can actually lose more than you originally started with. You could be liable for more losses, even when your trading capital has all been taken away. So please, make sure that you understand those risks and don't ever use money that you cannot afford to lose. Right, so that's that one. Let's just move on. As always, it'll be David and myself, who's sitting next to me, who'll be running the session, and we will be looking at the Forex markets through the prism, as always, through volume price analysis, supported by our absolutely stunning quantum trading tools. And I know we have customers, users who come along, who use the tools, and it's lovely to have you join us. We can never, in this market, not just the general market, but the whatever tools you use, you never really stop learning. But what we also focus on is volume price analysis. It's the methodology that David and I use and have written about and continue to write about, and it's on the books at Amazon, which is really your technical analysis foundation. It's the way you interpret the charts. And what does technical analysis do? What does volume price analysis do for you? It really helps you anticipate what is likely to be happening next, because it understands the relationship between price action and volume. It's in the books at Amazon. Again, I know we have traders who come along who've already bought the various books that are available. For Forex, what we've done is we've put it together in what we call the complete Forex trading library, because once you've mastered the technical analysis side of trading, then really have to understand the other drivers for this market, which is the fundamental and the related markets. And this is something that is covered in huge detail in the program that we have put together. And as you can see here, these are the four capital markets: bonds, equities, Forex, and commodities. And as I said this morning, the Forex sits at the center of the market, and the currency and currency pairs are kind of proxies for risk and sentiment. And if you understand that, and you understand why things are moving, because something is happening in another market, such as equities, such as commodities, and of course we have also the political aspect of the political risk that we also have to be aware of when we are trading. But you can discover a lot of what we say in the books. Some traders, that's all they do. They've just bought the books and they're perfectly happy, and they've integrated elements of BPA, the elements from the explanation of the fundamental factors, and also the relational as well, and they're perfectly happy, and they go out. Other traders who maybe want to take that knowledge and expertise a stage further, that's when the Forex program comes into its own, because it kind of pulls everything together, and really you get a deep dive into volume price analysis, price action, just everything you can think of in terms of technical analysis, and then all the other elements as well. So it's really pretty much where you are in your trading journey, what do you think you need in terms of where are the gaps in your knowledge. And the way we structured everything is, it really doesn't matter if you're a complete beginner, you're maybe intermediate, or even, I have to say, even advanced traders have taken the books and some of the and the program as well. You can never stop learning, and David and I are absolutely thrilled by it, because as I said, we've tried to make it relevant to as broad a cross-section of traders as possible. Now, the quantum trading tools, again, I know we have a lot of our users come along to our webinars, which is lovely to kind of meet you, as it were, in this environment. We've actually got the windows open, and there's an awful lot of, there's a bit of a racket going on, and I know, I'm pretty certain you can't hear it, but I can hear it in my headphones, and it's a little bit annoying. Right, getting back to the quantum tools, applicable to all the markets, all time frames, whatever you trade. But for Forex, we have 4 very specific ones, which we have bundled together in what we call the currency dashboard, the CSI, the matrix, the array, and the heat map. And we will use these tools to really help us find potential trading opportunities. Your tools also tell us an awful lot about the sentiment that's going on and what is going in other markets as well, because as I said earlier, these markets are all connected. So for example, if the yen's being bought and bought heavily, we know that equities are doing very, very well. If the yen is being sold heavily, we know that the mood in the market is rather sour, very negative, and there's a lot of fear coming into the market. So whilst these are, Forex traders do use them, even if you just have, if you trade other markets such as the commodities or the indices, having something like a CSI on your dashboard really to tell you how the sentiment is changing, well, these days, second by second, minute by minute. You don't have to buy them as a complete dashboard, as it were. They are available individually, and when people say, traders say, well, what should I start with, we always say at least start with the CSI, and if possible squeeze in the matrix as well, which is, and I'll explain why when we have a look at the chart. But you could just buy one, you can buy a bundle, or you can buy the full package. If you buy one and then upgrade later on, you will always get a credit. If you buy the package, when you have the package, there are lots of benefits for having the full package, not least is when we develop new indicators, they will automatically added to your package, so you never have to pay us anymore. It's 24/7 support. That's for everybody, by the way, whether you buy one indicator or the full package, and all the upgrades are free. That's upgrades to the indicators, and if there are any upgrades to the platform as well. All covered by 7-day money-back guarantee. We do MT45, NinjaTrader, TradingView, and we are working on TradeStation, which is very cool and very exciting. If you want more information, quantumtrading.com is where you'll find all the videos, support pages, everything you need to know about the indicators. And as I mentioned earlier, the complete Forex trading program, it comes with a full package of trading indicators. You simply have to select the platform that you would like to use. And as I said earlier, if you've bought anything from us, you will always be credited. And actually, in terms of cost of the program, some people say, well, is the education element of the Forex program is less than $500. You have to add on, obviously, the cost of the full package of the indicators, but the education element is really just, it's under $500. So if you have the full package, for less than $500, you will have, I can't tell you how many videos there are. It's a self-directed program. People ask us, well, how long is it going to take to work through? Well, we reckon if you do a couple of hours a day consistently, about 3 months, David, would you say? Could you get through in 3 months? And as I said, by the end of it, your knowledge of this market, and actually of the market generally, because as I said, we look at all the capital markets, and the fundamental data, is applicable to not just Forex pairs, but obviously equities as well. We think it really is without parallel, and at the end of it, you really will have all you need to know to trade Forex. I say other markets as well with confidence, but it is specific to the Forex market, and the website for that is quantumtradingeducation.com. And I don't think there's any, there's my site. Here you'll find latest analysis, updates to what is going on the various Facebook pages that I run, my Twitter feed. I'm really very proud of it. The Facebook page has got over 30,000 followers now, and I think it is 30,000 followers. They all religiously read all the analysis. I think Twitter's got like 15,000. Yeah. Yes, I'm always slightly stunned, actually. So many people take the trouble to take the feed and keep up with what we are saying. But the analysis on the site covers the whole spectrum of instruments. There's a lot of stock analysis on there. There's commodities and obviously Forex as well. But the Forex is handled through the Forex page on Facebook. Right, I'm just going to stop there, pass over to David. And yes, and in fact, I think we're going straight over to you, darling. Right, okay. This morning we looked at the Aussie dollar, which has absolutely done, you know, a little bit up. I think it's only moved 10 pips from this morning. So we'll move over to David. What are you looking at, by the way? Pound yen. Oh yeah, great. The pound, in fact, I was looking at the CSI, and in fact I was going to say, look at the pound, and the yen has suddenly shot up. So let's move straight over to David.
Thanks, Alan, and a very warm welcome from me. Just show my screen. There we are. Should be coming up. There we go. Yep, I can see it up on Anna's. So that's great. Just wanted to grab this while it was developing, because it's a really nice reversal developing on the pound yen. We've seen some pretty strong moves in cable this morning, or certainly for the pound, pretty much across the complex actually. But what I wanted to highlight was really just drop onto the CSIs. Let's have a look at them across the timeframes. This is the currency array. But up onto, this is 15 minute. Pound is very strongly overbought. You can see it right up in the overbought region, just starting to curl over. And down at the bottom here, you've got the yen just starting to rally a little bit. And that's a really nice potential reversal developing. You could also look at it against the dollar, obviously here, the red line. So really spoiled for choice. I've chosen to have a look at the yen, but as I say, you could look at euro pound as well. You've got the euro rising pretty strongly, and if the pound's going to sell off, you'll see the reflected there as well. Down onto 10, there it is developing nicely, and over onto 5. And as you can see on 5, it's already well underway. Very strong buying of the yen, pretty strong selling of the pound here as well. And what's interesting is when you look at currencies moving together, you'll see it on the array. I'll go back to the array in a moment. When you look at the array, you look at things like pound Aussie and you wonder, why isn't that developing a trend? Well, it isn't, because the Aussie and the pound have sort of been following one another around. They're starting to diverge a little bit now. But let's head back to the charts, because I just want to show you on the 15 how this is setting up. Let's go over here. Here we go. And really all that weakness was signaled on the charts also from a volume price perspective. You had this rally, the move away from the volume point of control down here at 135.60, through this out of this channel of a very well developed channel of a nice platform below and a nice ceiling above. And once you break away from that, you've got protection to the downside in terms of reversal and a nice platform below. But then as the move develops, look at the volume that's developing over here. This is London. The nice thing with Ninja, or one of the many nice things with Ninja, is that you can actually pick out real time in local time. So this is 8 o'clock our time. So this is the London Open. This is Europe Open here. So all of this volume is comparable, because we're comparing like with like. We're not comparing apples with apples, apples and pears rather across the session. We're just comparing apples with apples. Got 3 nice candles here. Volume is pretty much the same on all 3. We see some initial weakness coming on this candle, but it's not enough to reverse the market. Then we get another one, same volume, further weakness. You know, this is now looking a little bit weak, further weakness coming in. And finally, on the last of those 3, we get a strong signal that this is a market that is very overbought, very overextended, looking tired, looking exhausted, looking for a potential reversal. But that's what you're looking for. These are anomalous candles, because if this were true, then what you would expect to see, perhaps you could get away with a little bit of wick to the first one, but certainly on the second one, you would expect to see, you know, a decent body closing up here somewhere, not halfway back down. And certainly on the third, it's way off the highs, and you've got a narrow body and a big wick to the upper body of the candle, and very strong volume below. So it's telling you at the very least, pay attention. This market doesn't look very strong. It doesn't mean that it's going to roll over from this one and give you a nice V-shaped reversal, but certainly that all the signs are there that we've got weakness. The next candle, we get a little doji, volume falls away, doesn't give us any particularly strong messages following the other 3. Then we get another nice strong signal here. Again, attempt to rally, decent wick to the upper body, little wick to the lower body. It's a sort of doji, but it's got more weakness than strength. High volume. This candle, I would like to see maybe a little bit more volume, but nevertheless, you've got very limited wicks top and bottom, so it's pretty much pure selling in there. Certainly to the downside, there isn't a great deal of buying going on in there, and decent volume associated with it. So it's not anomalous; it's in line with what you would expect. And now what we're looking for from a reversal perspective is, well, how far is this likely to go? And the question that is answered in that way is when you look at obviously things like where the volume point of control is, how much volume you've got to battle through, and what have you got in the way of potential price regions from a support perspective, which could well come into play across the various time frames, of which, of course, this one here is the first, certainly on the slower time frames, at any rate, down at 64, 63. So there's roughly 10, 12 pips of value in there before we get to an area where we would expect the market to congest and pause for various reasons. And then it's a question of looking across the other time frames. What have we got going on? We've got the trend monitor here. This is the 1 minute, this is 2 minutes, this is 5 minutes, so these are all pretty quick. Decent volume under that last candle there on the down candle. Got a little bit of buying coming in here on 2 under this candle here, so expect maybe a minor rally. But in terms of the trend monitors, bright red here is transitioned already, so scalping traders will be into that one straight away. It's transitioned here on 2. It's starting to transition here on 5. Hasn't transitioned yet down onto 10. You wouldn't expect it to, nor indeed down onto 15. And that's really just the context. That's the daily chart bottom right. Just gives you a context of what you're trading, which is very much with the, in inverted commas, longer term sentiment, which has been very bearish towards the pound, but we've seen some rallies for it today and a little bit yesterday also. But the longer term sentiment, as is self-evident from the chart, is still pretty bearish. That doesn't necessarily mean you're not going to trade to the long side. It just means that if you're trading short, then you are trading, generally speaking, with the broader sentiment for that particular pair in the very longer term or the context of a daily chart. Just head over to the back to the CSIs. There we are, starting point as always. That's on 5. That's on 10. So we've got quite a way to go on 10. And there we go on 15. We're just getting underway. And really, that's just, it highlights what I was saying this morning about you as a trader and what it is you are trying to do in terms of your chosen time horizon, because rest assured that what a trader on this time frame is doing and is now eyeing this as a potential reversal to hold that maybe for, I don't know, an hour, maybe longer than that, maybe 2 hours if on a 15-minute time frame. Accepting the fact that within that context of time, the CSI down at this level and probably down even more so at a 1 minute or 2 minute level is going to oscillate around. You're going to see the pound selling, buying, selling and buying, and that is going to go on continuously, whilst the slower term trader down here is quite happy to sit through all of that on the assumption that this is going to go, and it won't necessarily, it's not necessarily guaranteed it will, but that we're going to see further buying of the yen, and this will gradually move up to here, and further selling of the pound, and this is moving off the overbought region. And all of that oscillation is going on in a faster time frame, and yet for the slower time frame trader, it's just part and parcel of life. It's the pauses, the congestions, the minor reversals, the little pullbacks that you accept as a trader. And it doesn't matter what time frame you're trading, whether you're a scalper or whether you're a long-term swing or trend trader, you will see exactly the same. No market ever goes up or down in a straight line, and you have to accept that fact and live with it. And it's why you have to define what it is you're doing from the outset. Am I scalping this on a 1 minute time frame? Am I looking at this over a 15-minute time frame? Am I looking at a 4-hour time frame, an hourly or 4-hourly out to the daily, whatever it may be, and trade accordingly within that context of time? The analogy I've used many, many times, which is actually reasonably good, is that of a blinkered horse. Horses are blinkered because they lose attention. They have to focus them on the finishing line. When they get other horses coming up alongside, they're distracted and they lose focus. And it's exactly the same here. You have to think of it in the context of blinkering yourself into a relatively narrow corridor of vision, if you will, and to exclude everything else and just focus on what you're doing. And you can be a scalper 1 minute, and you can be a longer term trader on another chart for something else, even for the same pair, to be honest, as long as you're doing it in separate accounts and you know which one's which. So I can't stress this too strongly, because we see it a lot in the forums. People get frustrated because the market moves in one direction, then it pauses and maybe pulls back a bit, and they're stopped out because they haven't set the stop loss wide enough, or they haven't been absolutely clear in what it is they are trying to do and accept the fact that the market moves in oscillation the whole time. It's wheels within wheels. It's the Russian dolls, if you will, a tiny little Russian doll in the middle, and then gradually it comes out to the largest doll on the outside. It's the same sort of concept and principle here. Just go on to the 10-minute. There we are. That's developing nicely. Down onto 5. That's okay. That's crossing now. Got some other decent moves here. We've got the euro rising strongly against the yen, but then you wouldn't look at the euro yen as a trading opportunity. Why? Because I can tell you without looking at the chart that is probably in congestion. There might be a minor trend one way or the other, but certainly from a trading perspective, it's not the one to go for, because the two are rising together. Therefore, there's no differential momentum between the two. In other words, they're both being bought. One may be being bought a little more strongly than the other, which will be enough to create a differential momentum in the trend, but it certainly won't be anything like the strength that you're seeing in the pound yen, or indeed in the dollar yen. If you were trading dollar yen, exactly the same principle. Dollar's now selling off quite strongly, yen's still rising strongly. And the same principle would apply to the Aussie. If you look at the Aussie yen chart, the Aussie is rising with the yen, so the two are running together on parallel tracks. No great differential, and the same is true of the New Zealand dollar up here, which is being bought very strongly as well. So there'd certainly be quite a decent move, certainly on New Zealand dollar or New Zealand Swiss. And that's why we will start with the CSI, because it filters all this out into what pairs to look at, what pairs not to look at, and where are the best opportunities. Back up to 15. There we are, it's getting underway. Right, onto the matrix. This is on 5 minutes. Just isolate out the pound there. There we go. It's just starting to get underway. This was down at the bottom here, I think, not so long ago. It's just starting to lift off. The euro pound was up at the top. Now we're starting to see that develop. We go over onto the currency array. Here we are. This is on 5 minute. We've got the pound CAD at the top. This is, again, I've isolated these out on the pound. Got the euro pound at the bottom. And what you're expecting to see if this develops, we go up onto, let's go up onto 15 and just isolate out the yen. There we are. That's where we are in terms of the yen at the moment. The pound yen, I think just before we started, 2 or 3 of those were right at the top here. They're just starting to come off. You can see the strength of this, the gradient of this line is just starting to flatten somewhat. And if that sentiment continues, then all of these will sweep below the midpoint, the fulcrum here at 0, as that yen sentiment shifts and changes. And if the euro yen, as you can see here in the middle, I highlighted as one you wouldn't look at, and that's the reason why. Because for the time being, over the next few minutes, it is sat there in the middle purely because the euro and the yen are moving in the same direction. So there's no differential momentum to drive that one way or the other. That will change at some point, because they always do. But for the time being, it's not the one to consider. You'll be looking at the others, which are moving off the highs and coming into overbought and oversold condition. Just go back onto the charts again. See where we are. We've got a volatility triggered on 1 minute. What does that tell you? It tells you there's going to be a potential reversal, and it's happening right now. As soon as the volatility is triggered, then your expectation is that the market may either congest or indeed reverse, which is exactly what's happened. This indicator triggers in real time. As soon as volatility appears, you can be assured of 2 things. First of all, the market's going to move quickly, and it's moved outside the average true range. Secondly, that the market makers are in there participating, or they're creating a trap move. Because when the market moves quickly, you can see it here, and you can imagine it. Unfortunately, I didn't have the chart up at the time, but as soon as the market drops like that, very fast, your natural reaction is to jump in, because you don't want to miss out on an easy opportunity of a nice simple short. Bang, market reverses, and that's the power of the volatility indicator, and it happens in all time frames, whether it's a 1 minute. We had some on the weekly chart, I think, for gold off the top of my head, which is very unusual. You do get them on the daily, but to get them on the weekly is very unusual. There's been a lot of volatility in the gold market. Exactly the same thing happened. We get reversals, pullbacks into the spread of the candle. And then it's a question of reading that and waiting for the chart to develop and move away from that particular region. But as soon as you see, and it's again, it demonstrates the power of multiple time frame analysis. As soon as you see that on a 1 minute time frame, and you're maybe down here on 15 or 10, what's it telling you? Well, it's telling you the market's likely to, at the very least, pause or possibly reverse. So don't be surprised if you're short this market and you see that coming in your initial response will be great. More downside momentum. As soon as that's triggered, it's, oh dear, right, we're going to see it pull back. So it just removes the element of surprise. It removes that emotional response when you've got a decent position in the market and then something occurs in a different time frame, and it's just a question of reading what's going on in the various time frames up and down. You can see here on the 1 minute, the trend monitor has started to transition out of that bearish phase of price action. It's starting to transition back into a positive sentiment. This is also starting to reflect that a little bit. This is still into a transition to the longer term, in inverted commas, bearish sentiment at the moment. Down here, we're starting to see some minor changes too. And down onto the 15-minute, no flicker of a change yet. Trend line is diving down there. We've dived below the midpoint on that one. This yellow line is part and parcel of the trend monitor. It's the trend line and the trend monitor, which come as two indicators in one, if you will. And it just gives a sense of how far away you are from the midpoint of the trend. In other words, how strong the trend is. And the steepness of the line will also give you an indication of where that trend is developing and how strongly. Yep. So where are we heading now? Well, we've got the volume point of control here. We've got the volume point of control here as well. So the prospect is that once the market gets to these sorts of levels, we're going to see congestion. We've got high volume around these regions. Market's not going to go very far. It's just going to congest around there for the time being. But that was the classic signal, which would have signaled the reversal coming into play, and it's gone back up again. Let me just pass back to Anna at that. Are you okay over there on the? Are you? Yep. Okay. Hold on. Just going to pass back to Anna. Oh, just before I do that, sorry, that's okay. No, it's all right. I'll switch over. Don't worry. No, I was just going to pull up the indices, just see where we were on the currency indices. Sorry, just drop that out of the way. There we go. Sorry, that's the equity indices. What I actually wanted to go to was this. There we go. This is the currency indices. Just see where we are. These are all on 5 minute. Top left is the yen. Top right is the dollar. You can see the dollar's selling off reasonably strongly at the moment. And on the bottom left, we've got the euro. We've got some buying of euro, and we've also got the pound. That was the initial move on pound yen. A little bit of buying coming in on the pound again. Strongest move at the moment is actually in the dollar. Yen going sideways. A little bit of euro buying, but certainly in terms of the strongest move at the moment, it would be over on the dollar. So perhaps the dollar is a better choice than the yen right now. That's it. Okay. Yep.
That might have been something to do with GoToWebinar, so I do apologise about that. And what I'll do is once we've had a look at the pound Canadian, actually, maybe we can go back and look at the indices again, which are basically telling what the individual currency are doing. Right, just very, very quickly, I pulled up the pound Canadian because it's a really, really interesting chart. I actually wrote about it on my Facebook page. Let's just undock this, and also choosing. We have a look at the, let me move that down to 30. We have a look at what the individual currencies are doing, and then we have to go and scope out where perhaps there is the best opportunity in terms of the pairs. And obviously we always start with the with the currency strength indicator. This is the move higher that we've seen in the British pound. It's reaching a point of being overbought. This is the 30-minute. This is my 30-minute chart. I tend to use on my MT5. I have a daily, I have a 30-minute, I have a 3-minute chart, and I have a Renko chart. My 30-minute chart is like my kind of benchmark chart. It's what I'm. It's how I'm. It puts the context, it gives me context to what is happening on the 3-minute chart. Some people like to use the hourly chart, but I find that's a little bit too far away. And I do confine myself to these time frames, as I said, with the Renko. So what I can see here at the moment is I can see that quite clearly that the pound is being bought. The Canadian is also being sold quite strongly. We can see that from the steepness of the line. And as David was looking earlier, the move that he's been looking at is the rise in the pound and the fall in the Japanese yen. There's been a bit of a, looks like it's been that sort of a curling up as we speak. Now, those are the individual currencies, and you can certainly pick a currency pair from the CSI. But if we go to the matrix, what the matrix then does, takes that information and it then ranks the pairs for you, so you can actually see the strength or otherwise in perhaps the pair that you had highlighted on the CSI. And what I want to draw your attention to is, first of all, it tells us which of the CAD pairs and also which are the pound pairs are doing the best, if you like, in terms of a long position, and which are sort of being more heavily sold. And in fact, the pound Canadian and the pound yen are the two pairs that would seem to be offering, certainly have offered a trade to the upside, and they are reaching this point of overextension, if you like. And these numbers that you see here are actually really, really useful because, first of all, you can use them in terms of comparison with, this is at plus 30 and this is at the weakest, if you like, is at minus 17. So it's kind of telling you that the move, we have seen a bigger move in the pound yen going up than the euro pound going down. What it also tells you is how, if you look at all the pound pairs, which is obviously the strongest, and we can see here it's been a close call between pound CAD and pound yen. And once these numbers kind of run away with themselves, that the higher the number, we know it's becoming more and more overextended. So what happens is, with overextension, you will either sometimes get a burst of volatility coming in, which will kind of push it a little bit further. And that's when traders get trapped, because they see something has been moving up steadily. Then you get this final sort of push, and then suddenly the wretched thing suddenly reverses. And it's just, it's a great way to trap traders. They don't really understand this kind of volatility. They don't understand the overrun that you can get in any market, actually, not just currency, not just the current forex market. But these numbers are actually quite important on the matrix. So what we're looking at here is the pound Canadian. Now, with the pound Canadian, as I said earlier, if I can move that out of the way, I actually highlighted this because if you look at the daily chart, the pound has been under the cosh. I mean, it's been relentlessly sold because of Brexit. We haven't mentioned Brexit for at least three webinar sessions. I mean, gosh, the B word has completely gone out of our vocabulary. And I highlighted it because obviously when the pound is being sold, people look at cable, they look at the pound yen, they maybe look at euro pound, but these cross pairs can sometimes give you these amazing trends. And this is a trend and a half. And as I said earlier on the post, the trend started from the break from the volume point of control. Volume point of control, for those of you who know, it's that area of the chart where the market has been in congestion for a reasonable amount of time. If I kind of zoom out a little bit, we can get a better idea. There we are. If you can see what preceded this move, a lot of very, very choppy price action, days when you had big up days followed by big down days. But in the main, the price was within a range. It can sometimes be quite a wide range, and the range, and with this particular pair, the threat was always that it was going to go to the upside. How many times was this level being tested? 77, 35. In fact, this goes back all the way back to February. But as explained in the books, congestion phases, consolidation phases are where trends are born. They are the spawning ground of trends. Congestion phases are also where breakaway trades start. And you can see from looking at this, now this is the daily chart, but you would see exactly the same price action on a 5-minute chart, a 20-second chart, an hourly chart. Traders really don't like this kind of price action because why? Because of the number of fake outs. So you look at this and it looks like it's going to break away, and suddenly it doesn't, and it goes back to retest. It goes back to into the, if you like, the arms of the congestion phase. What the VPOC does, which is so brilliant, is it kind of puts that on the chart for you, so you know what to expect. When I said VPA is anticipation, what are you going to anticipate? You can anticipate that at some point there is going to be a clean break away from the volume point of control. And it's patience. Now, this is the daily. Does that mean there weren't trading opportunities in the faster time frames? No, of course there were. Again, it goes back to your time horizon, so that in the end we did got a clean break, and the break was actually, it was the break. But what's important is where support and resistance comes in, because support and resistance is also a key part of VPA, is once it broke through this support platform at 73.34, and you can see the number of times it was tested. Here we are. I mean, sometimes they poke a little bit through, but in the main it held. This was a very, very strong platform support. Once that platform went, then the trend carried on lower. Now, that also coincided, obviously, with the general huge selling off of the British pound. We got a really nice waterfall. We had falling prices. We had rising volume as well. Now, sometimes the volume is slightly lower, but you have to remember these could be, this is bank holiday, isn't it, David, in May? Sometimes you see this, yes, around, it'll be either the May Day holiday or actually more. So don't, you have to, with the daily chart in particular, you do have to remember when you see these, perhaps the volume looks a bit odd, and you think, oh, that doesn't look very clever. You have to also go back and think, was there a holiday? Is there a seasonal factor for that? What this trend lower also confirms to us is really Wyckoff's second law, which is the law of cause and effect, which essentially says the longer a market is in a extended phase of price action, i.e. in a range-bound consolidation, then the longer that is, the greater the move will come as a result. So we can see the length of time that this pair was in consolidation. Then we had the beginning of the sell-off for the British pound. Is it any wonder that it's just carried on lower? The trend dots obviously turned red. This is the trend monitor, which is still holding, which is relentlessly red. And what we need to do, again with VPA and looking at candles, most times when we had an up candle here, accompanied by high volume, that is anomalous because why? It's a narrow spread, very compressed price action, lots of volume underneath it. What does that tell you? It's not going to go very far. Look at the up candles. Again, here we have two candles. This one is narrower than that one with the same amount of volume. What is that telling you? Yeah, those days were up days, and there were probably opportunities to the long side, but on this chart, this isn't going to go any further. We had a sort of a mild section of price action, which is in consolidation before the trend lower was restored. This is a very nice candle. Wick to the top of the candle, a lot of volume underneath there, a lot of selling in there. Then we had another up candle here, and that one there, you've got a wick to the bottom, reasonable amount of volume, but again didn't go very far, hit the resistance, and the next day was actually an inside day, because the inside day was in the spread of that candle. And when you get that inside day, is it a reversal? Sometimes it is, and also other times it's just simply more consolidation. And it wasn't until this platform was broken, which is 66.81, and so it carried on. And you can see here the volume is actually rising under the down candles. Then we had another effort at rising. Again, a very compressed candle, a lot of volume, didn't go very far, and down and down is it. Now, as I said, everything comes to a point where, you know, moves do come to an end. And if we look at the heat map, the pound CAD is actually right at the bottom of the heat map. So that is telling us that at some point, it's been there for days and weeks, and it's just been relentless. Look at the numbers on the monthly chart. It's a huge number. The monthly chart, the weekly chart, the daily chart, all you know, big numbers, still relentlessly red. But there has been this opportunity today to take a trade to the upside. Why? Because it was signaled on the CSI and on the matrix as well. And actually, what this has done while we've been speaking, this VPOC was down here, because this move actually started off 163.45. Now it's gone back into congestion. This is kind of the reversal. With reversals, it's very tempting to say all reversals happen as a V shape. So all you need, price moves in one direction, you get a couple of candles at the top, maybe a couple of shooting stars, a hanging man, and down you get, but it's in a V shape. At the bottom, you get a couple of hammer candles, maybe a test on low volume, and up it goes. In reality, what happens is when reversals are setting up on your chart, what you will get is the up move will come to a pause point. It will run out of steam. You will get a degree of volatility, which we had here with this up candle here, a retrace into the spread of that candle, and then a move sideways into consolidation. We've actually had a volatility candle also fired to the downside as well. But essentially, it's got to now break away from that volume point of control. If we look at, as I said, I only use the 30-minute chart. What have we got here? Well, we have a weak candle. We have a wick to the top of that candle. What we're expecting perhaps the price to move lower. There's a lot of volatility coming in at the moment. Now, looking at the, oh, of course. Oh, who's talking at one? Oh, it's the CPI. Is it US? It's US data. Oh, there's US data coming in as well. This is the move higher that's captured by the Renko. Now we've got the consolidation. The way Renko works is it absorbs the volatility that comes into the market, either from a piece of fundamental news or, you know, a geopolitical event, whatever the reason it is. What the Renko does, it simply absorbs it, and you can then decide whether you want to stay in the trade or come out. And we're just waiting now to see whether the very longer term trend is going to be reestablished, or whether this is now coming to a point where we are maybe going to go sideways for a little bit prior to actually moving higher. So that's what I was. Anything you want to add to that, Glenn?
No, it's just the CPI come out.
Oh, CPI, that's for the US, isn't it? But that's because the Canadian is part of this. US data will always impact the Canadian as well, because the US is it Canada's biggest trading partner? It is, isn't it? Yeah. Right. What I also mentioned this morning was in terms of risk. When you are this morning we looked at taking a trade in Aussie dollar long just before the London Open, and I think it delivered something like 10-12 pips. It wasn't a huge amount, but it's very much against the run of play, where in fact the Aussie dollar short, I do beg your pardon, yes, against the run of play for the dollar, because the dollar's been sold off. Why is it being sold off? Well, Powell has come in, the Powell put, as they call it. It was like the Greenspan put, where basically the Fed stands as stands behind the equity market, and ensures that the equity market will carry on higher. A consequence of that is a sell of the US dollar, and that's been sold off quite heavily. Powell is back this afternoon before Congress. He's continuing his testimony, so we can expect lots of volatility. Will that push the dollar further lower. We don't know. Donald wants a weak dollar. Emerging markets want a weak dollar because their debt is denominated in dollars, and that makes their borrowings much cheaper. I think even the Chinese want a cheap dollar because their currency is actually pegged to the US dollar.
Lots of dollar buying.
Lots of, oh, is it gone the other way now? There's lots of dollar buying. Anyway, to get back to risk. So whatever time frame you trade, you're always going to be trading counter to another time frame. You've got to be aware of that, and it depends how comfortable you are. Some traders say no, you must always go with the dominant trend. Well, it depends what, as I said, it depends what time frame you're looking at, because the dominant trend, obviously in the daily chart for the pound CAD, well, it's clearly bearish. It may be having a little bit of a correction and a pullback, and we've seen the corrections and pullbacks further back in the daily chart. And you say, well, is it a legitimate? Will there be a legitimate trade down in the faster time frames? Well, I would argue when the VPOT was down here and we were looking for a breakaway and it was supported by the Renko with the trend dots and the trend monitor, we were looking at 63.52, and let's say we took it up to here when we have a shooting star coming out, 63.52, that's 63.98. Well, on a 3-minute chart, I think that's a reasonable trade to take, David, isn't it? Because I have been told by traders, oh, you don't get trends in very fast charts. Well, it's absolutely ridiculous. You get trends in all time frames. It's just a case of how long they take to develop. It could be 5 pips, but in a cross pair such as this, that is a reasonable trade to attempt. The amount of risk you put onto that trade, that is going to depend partly on what your trading capital is. But the way you can look at it is, because there's another question asked, well, how much money am I going to make? How much do I lay out, as it were? And although obviously the money aspect is important, you as a trader, what you should be looking to do when you start is you should be looking to become consistent in terms of the number of pips you can take out of the market. The money element of it, the value of those pips, that is almost secondary. In fact, it is secondary, because if you can prove to yourself that you can take 20 pips out or 30 pips out or 100 pips out on a day or 100 pips out on a week, it doesn't matter. You set yourself an objective. You say, do you know what, I'm going to try and make, I don't know, 100 pips a day. Some days you may not do any, some days you may do more, but set yourself that goal. You can't set yourself the goal of saying, I want to make $100 this week. It just doesn't, your brain, trust me, it doesn't work in that way. Now, what you then do, once you become consistent in taking pips out of the markets, and we always suggest you start using micro lots, which are 10 cents a pip, and nobody's going to set the world on fire with 10 pips, 10 cents a pip. But that's not the point, because what you then do is you start with one micro lot, then you move to 2, then you move to 3, then you move to 5, then you move to 15, then you move to 20. That's how you build it. You don't necessarily have to move up to mini lots and full lots. You can't actually use the mechanism of micro lots to actually build your position, and you could get to a point where, I don't know, you see a trade, you see a trading opportunity, you're comfortable about taking consistent pips, you may put 6 micro lots in, which is 6,000, which is half a mini lot, and then as the trade moves in your favor, you can then perhaps take some of that off the table. Difficult, I know, when you're starting with one, but the objective is to start with one and to stick to mini lots and build your confidence in this way. Is there anything you want to add to that? I can't think. Yeah. And what it also does is, when you are then looking at a trade which is perhaps against the dominant, let's say the dominant trend in the daily chart is clearly still bearish for pound CAD, although it's very overextended, and possibly it's going to, at some point, it is going to reverse, because everything does reverse. By doing it in this way, by using micro lots, you can then you can adjust the risk on the trade itself, and the monetary risk is easy to calculate. What's much more difficult is the risk on the trade itself, and you adjust that by the position size that you put in the market. So if you're taking something that is, on the fast chart, clearly very much against the primary trend in a slower time frame, but it looks like, the setup looks right, everything looks right, the indicators are telling you, this is an opportunity, the VPOC is in the right place, and it moves and it begins to, move away and move nicely away, and there's 5 pips come in, 10 pips come in. You should then have the confidence to take it, but you wouldn't necessarily put, I don't know, if you're trading 5 micro lots, you wouldn't put all 5 on in that case. Maybe you start with 2, and then as the trade moves on, you then add another 1 and then another 1, and you take 2 off. This is how you play with your position sizes. Is there anything you want to add to that? Have I given it right on a risk? At the moment, what's happening with the pound CAD? Well, it's still actually rotating around the volume point of control. So here it's a case of being patient. Let me see what let's have a look what this is. It's still actually on the 30-minute. Let me just move that down to let's say the 12-minute here. Where is it here? A pound CAD. We've had a little bit of a move. Where is the pound CAD gone? Oh, it's down to spot 13. Let's have a look at the CSI. Yeah, you can see here we've had a sort of, looks like a bit of a reversal, then it kicked up high. But what's interesting about this chart is the pound is moving up, so is the Canadian dollar. So what is that telling us? Well, it's telling us there is a degree of congestion, because what the CSI does, it just doesn't highlight potential reversals and potential trades. It also tells you, well, what is happening on the chart. This pair at the moment is moving sideways. We know it's moving sideways on the 3-minute, as we can see here, it's around the volume point of control. Let's just have a look at and what's interesting about the Renko, the Renko is picking up all this volatility and this congestion. We've had the trend dots change. That hasn't gone to bright red, but that is actually still blue, which is very, very interesting. And I think most traders would have taken their position out somewhere around here. And what this can also do, it can also highlight maybe the time that as a re-entry, a breakaway from congestion on the 30. This is the move higher. In fact, that weakness didn't materialize. It bounced off here because we had the news come out. The next question is, well, where is it heading? Let's have a look. It's going to come up to what we call a low volume node. The low volume node is great to see on a chart because it means it's going to move through really quickly. So let's move up the time frames and see if we can find some kind of, there, that's a nice resistance up there. 64.10, that looks like a nice resistance. Let's go up to the 2-hour chart. See if we've got something else. No, we've only got 64.14. Let's stick to the hourly, that's probably best. That is quite a significant, and why do we know it's a significant resistance? It's because it's a solid line, not a hatch line. So, how much movement, how much potential is in this trade? And in fact, it's another trade that happened off the volume point of control on volatility, on a big volatility candle. The first thing this next candle did was go back into the spread. It looked like there was a bit of weakness there, but it has actually continued higher. And so it's 64.09 is possibly where that is aiming. Let's go back to the 30-minute. Take that down. What is the Renko saying? In fact, this setting for the Renko is on the ATR, and in fact, it's actually at 3.25 pips. So it's actually, the Renko is quite slow on this one, and that's why it's absorbing a lot of the choppiness that you can clearly see here on the 3-minute chart. So when you see this price action, don't go, oh, what am I going to do? Oh, I'm never going to be able to trade this. Look at it in the context of what the Renko is doing. What is the context of this price action in the slower time frames, and also the context of what is happening on the daily chart as well. That's it. Anything else you want to say to it?
All I would add to that is, obviously, following the news, been a lot of volatility. The volatility has been triggered. I won't flick back onto my screens, but it's certainly been triggered on certainly on the pound yen and several other pairs as well. There's a lot of congestion now building, reversals back inside the spread of the candle. So it's again, the news events and Donald and any any excuse will be used to trigger volatility, because it's just a mechanism that the insiders use every single opportunity to move the markets rapidly and then to reverse into the spread of the candle, and either to congest for a long period of time or indeed a full-blown reversal, because that then applies emotion to your position. And it's a very simple mechanism. You're drawn in on the fast-moving price action because that is your emotional response, and then the market makers and the big operators will congest the market, because then time comes to play. It plays on your mind. You're not sure anymore. The longer that goes on, the less you think that this market is going to continue in the original direction, and you either close out at a loss or you get stopped out indeed if it is a full-blown reversal. But it's developing across the pound yen. Pretty much on all the time frames we had up, we've got volatility literally from the 1 minute through to the 15-minute now, based on that single news item. And the market is now reversing back in, hit 136. Now it's coming all the way back down, 135.92, and so on and so forth. And a ton of volume coming in, as you would expect on a news release like that. Absolute mega volume on a big number. So all I would urge you is, if you have the volatility indicator, understand what it's telling you. It's telling you, first of all, yes, there is volatility. In other words, the market has moved outside the average true range. You saw one come up on Anna's system. I can't remember which pair it was on, but it was literally, was it the pound CAD? It was coming up on a 3-minute or something, I think. It triggers in real time. In other words, you don't have to wait for the candle to close. It triggers as soon as the condition has been met that you've moved, the price action has moved outside the average true range, whatever that may be for that particular time horizon. And once that's triggered, then you have a decision to make, because the probability is that what will happen next is the market will congest, and congest for a little while inside the spread of that candle. It doesn't always, there's no always in trading, but generally speaking, that is what happens. So if you're in a position, and I've said this many times before on these webinars, if I've got a position and I see volatility triggered and I've got a decent profit in there, I'll close it out, because I don't want to sit through congestion that may go on for some considerable time while I'm waiting for that position to move in further into profit. It's much easier to close out, take it off the table, or even, as Anna said, partially, she was talking about scaling in. If you have a number of contracts in the market, then take some off the table, take half the position off, take 2/3 off, whatever it may be. If you've got 5 contracts, take 3 off, let 2 run. At least that way you've banked some profit. And it makes life easier sitting through that inevitable congestion phase. I'm literally watching it on my screen. That's what's happening right now. And you can almost sense the people who've jumped into this move, because they've seen the news release come out, they've seen the data, they thought, oh, fantastic, this is going to be a dollar positive or whatever it may be, risk sentiment, whatever. And then they're stuck in that position, and they're starting to stress about the fact they wish they hadn't done what they did and jumped in too early. That's the mechanism of the volatility indicator, and that's why it's so powerful. We've now got congestion building across the time frames on pound yen, and I'm sure in other pairs as well. I'm just going to pass back to Anna.
And this level here that we see here, that one.
It was the downside one, wasn't it?
Yeah, I've got 64.06, and as I said, we have to go all the way up to the hourly chart. I said, if it's going to aim for anywhere, where is it going? 64.09, 3 pips out. But these levels are certainly on this, on both platforms. It's the accumulation and distribution indicator on Ninja, support and resistance that have on MT5. They are absolutely pinpoint accurate. So it looks like maybe the downside, predominant trend that we have on the daily chart is going to continue. And what do we have here? We've got 63.85 to the downside. And what is the heat map? As I said, the heat map is great for picking out these pairs that are at these very, these big extremes, as it were. But what's interesting about the heat map is it's a great way. These cells are obviously, this is a multi-time frame. We've only got 1, 5, 15, 30 hour, 4. On NinjaTrader, I think you've got more time frames, haven't you, David, on this one? But this was based on MT4. And what's interesting, you can see the ripple effect going across the time frames. And what's happened is, as you can see here, very, very bearish monthly, weekly, maybe not so much on the day because it's reflecting that the little blue candle that we saw. The 4 hour is still bullish, the hour, and the 30 minutes, as we saw earlier. But you know, there's candles with quite deep wicks to the top of the candle, and this is what you're seeing on the 1, the 5, and the 15. Now, if these start to turn red, you can see then that this is the dominant, if you like, take the dominant trend as the slowest time frame, that is going to be re-established, and that's going to stay stuck to the bottom of this heat map for a little while longer. But as I said, don't expect V-shaped reversals do happen. They happen on daily charts, but they are quite unusual. What you tend to get is certainly you have to have stopping volume come in to stop the fall, if you like, especially on a very deep downtrend that we've had on this pair, and it has to sort of it's like a big cushion. It has to absorb all that selling. Stopping volume comes in, and then you have a pause, you have a period of consolidation, and possibly then a reversal. But sometimes the period of consolidation is just a minor correction, and then the dominant trend, you know, is re-established. Now in those moves, if you like, so you have the primary trend, which is the move lower. You can have a secondary trend, and those secondary trend and minor trends are perfectly tradable, but they do come with a little bit more risk on the trade, and this is where you play that by adjusting your position sizes. But really, guys, just stick to micro lots. I mean, we've got family members who we are teaching this stuff to. I mean, as soon as our eldest grandson is about 9 or 10 years old, he's going to be taught to trade as well. In fact, one of our customers, we couldn't understand it. He's one of our quantum users, and suddenly ordered a whole batch of extra indicators, of which he'd had, and we were really confused, because the other thing is if you buy additional indicators, which you may need for different accounts or what have you, you do get a really nice discount. You get 50% discount off, which is really cool. But we wrote to him and said, look, you do realize, first of all, you get 50% discount, but do you actually need all these indicators? And I really surprised. He said, guys, I'm teaching my sons to trade. How old are they? You did 13? They're teenagers. They're teenagers. Yeah, they're teenagers, and they're really, you know, we were just, May said, no, they have to know about this stuff, and, you know, teaching them VPA with the help of your indicators, and they absolutely love it. And when they're that age, they're fearless anyway, not like us. You know, they're not riddled with fear. You know, their dad is teaching them. We're really thrilled about that. So there we are. Any questions? I don't think so. No? Yeah, just can you mix the heat map out of the way? Yeah, sure, no problem.
This is just, thank you, darling. Are you off? You off? Sorry.
Oh, sorry, you don't want to hear.
No problem. You get a bit of echo when we've got both on. Okay. Yeah, I'm just going to wrap up. I just wanted to really highlight this chart because it's a really nice example of congestion phases and what you have to do to be successful in terms of tactical approach. If breakaway trading is your preferred tactical approach to the market, it is for many traders. It gets a bad press for one reason and one reason alone, in that those traders who give it a bad press, or those analysts who give it a bad press, do not use volume to confirm the breakaway. But this is a really nice example. It also brings in other elements. Clearly what we've got, we're trading around the volume point of control, the yellow line, which is fine. Good volume building around there. We've got a very nice ceiling of resistance built at 64.06. So that gives us our ceiling. And below that to the downside, we've got a decent floor in at 63.85. So that's our channel, if you will. The ceiling is much stronger than the floor, simply because we've got a solid line there as opposed to a dash line. The dash line is less strong, but where you get clusters of dash lines, that signals strength as well. And you can also get clusters of solid lines too. The key point to this is now, if you were looking at this as an opportunity, what are you looking for? Well, first of all, it's a question of defining your levels, which I've just done. Then it's a question of waiting for that moment to occur and for the volume to confirm it. And then once the price action has moved away from this region, assuming it is to the downside, because we've got the price chart to the left there to give us a heads up, then it's a question of how much is that trade likely to deliver for you in this time horizon. It's a 3-minute chart. So if you look at the chart, just eyeball it, what have we got? We've got light volume on the volume point of control through 83 down to where are we? Around about 66. So that's a decent move. So we've got very light volume there. We've got very little in the way of price congestion to provide any platform of support in a move lower. And we really start to then run into perhaps a little bit of difficulty down at 59. So in terms of the opportunity, assuming we get in fairly close once we've broken away from this region, it looks as though there's 10, 15, 17 pips, something like that of value that is a relatively low risk trading proposition, because above you, you've got a very solid area of congestion which would act as resistance. You've got some very nice levels to place your stop loss, certainly above the 6406 area, provided it fits your money management rules. So you've got a very nice low risk setup, both from a technical perspective and for a reward perspective, and from a technical perspective, certainly from the chart itself, to deliver an opportunity that looks as though it's a nice return for relatively low risk. And that is the way to view the chart. Once that market breaks away, the one thing this approach requires is patience. A lot of traders don't have patience. They don't want to sit here. I don't know when this is going to break away. All I know is that at some point it will. You can't say when. All you know is it's just a question of waiting and be patient. If you can be patient and wait for these trades to come to you, they are fantastic opportunities for so many different reasons, which I've highlighted there. Hope you've enjoyed today's session. We are back at, what's the time now? We've overrun time. Apologies about that. We are back at 3:15 our time, so roughly an hour and 20 minutes or so. So look forward to seeing you then. We're off for a cup of tea, and the dogs want their lunch. They're hungry. We will see you later. If you want to ask us any questions, please do drop us a line, either Anna at annacooling.com or David at quantumtrading.com. We'll be happy to answer them there for you. So I hope you've enjoyed it. Hope you've learned something you didn't know before. And we will see you later, and bye for now.